I keep hearing WACC thrown around. What is it, and why should I care as a beginner investor?
WACC is a company's blended cost of borrowing money and getting equity. It's the minimum return a business must earn to pay everyone who funded it.
So it's like a price tag for using other people's money? How do you actually calculate that blend?
Exactly. You weight each source by its share. If 30% debt costs 5% after tax and 70% equity costs 10%, then WACC is 0.3 times 5% plus 0.7 times 10%, which equals 8.5%.
Why do you say after tax for debt? Does that mean interest is cheaper than it looks?
Yes. Interest payments reduce taxable income, so the government subsidizes part of the cost. That's the tax shield. Equity doesn't get that perk, so it's usually more expensive.
How do you figure out the cost of equity? That seems trickier than just looking at a loan rate.
We use CAPM, risk-free rate plus a risk premium. The risk-free rate is like a government bond yield, and you add a premium based on how volatile the stock is versus the market.
Got it. Now, should I use book values from the balance sheet or market prices when weighting debt and equity?
Always use market values. Book values are historical accounting numbers. Market values reflect what investors actually pay today, so they give the true opportunity cost of capital.
Can you give me a real example? Say a company has a WACC of 10% and is thinking about a new factory.
If the factory's expected return is 12%, it creates value because it beats the 10% hurdle. If it's 8%, it destroys value. WACC is the line between good and bad projects.
So WACC is like a performance benchmark. How does it connect to ROIC, which I've seen in other lessons?
ROIC is what the company earns on its invested capital. If ROIC is above WACC, management is creating wealth. If below, they're burning it. That gap is the core of value investing.
What are the biggest mistakes beginners make when they first try to calculate WACC?
Using book values, forgetting the tax shield, using a wrong risk-free rate, ignoring preferred stock, and mixing up debt maturity. Those 5 errors can skew your hurdle rate badly.
If I'm just starting to analyze stocks, what's the simplest way to use WACC without getting overwhelmed?
Don't calculate it yourself yet. Look up a reliable source like a financial data site, then compare a company's ROIC to its WACC. If ROIC is consistently higher, that's a good starting signal.
That sounds doable. Any final tip for a beginner investor before I dive into my first analysis?
Remember, WACC is a forward-looking hurdle, not a guarantee. Always check if the company's competitive advantage can sustain returns above that hurdle for years. That's where real wealth is made.